Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Monday, June 1st, and we're kicking off the month with some notable developments in both markets and geopolitics. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story is the escalating tension in the Middle East that's sending shockwaves through energy markets. Iran has halted all negotiations with the United States and is threatening to completely block the Strait of Hormuz, which is a critical choke point for global oil shipments. We've also seen the US Central Command intercept Iranian missiles that were targeting American forces in Kuwait. This isn't just saber rattling anymore, and the market is responding accordingly. Oil prices have jumped above $90 per barrel, which is a significant psychological level. On the corporate front, we're seeing major M&A activity that closed out May on a strong note. Barry Diller's IAC is making a $48.30 per share offer for MGM Resorts, which represents a substantial premium. Meanwhile, Berkshire Hathaway continues Warren Buffett's strategy of betting on American housing with a $6.8 billion acquisition of homebuilder Taylor Morrison. This is interesting because it shows confidence in the residential market despite higher interest rates.
Those geopolitical developments are certainly concerning. How are you reading the market's interpretation of these events?
Markets are showing remarkable resilience despite the oil spike, which tells me investors are differentiating between short-term geopolitical noise and longer-term growth drivers. The AI narrative continues to dominate, and we saw Nvidia launch new ARM-based chips for PCs from Microsoft, Dell, and HP, which sparked a broader rally in software stocks. ServiceNow and Adobe both jumped on this news because these enterprise software companies stand to benefit enormously from increased AI adoption. What's particularly interesting is that we're not seeing the typical risk-off behavior you'd expect with oil at $90. The S&P closed May at record highs, and the breadth of this rally is actually improving. It's not just the Magnificent Seven anymore, we're seeing participation across sectors, which is a healthier foundation for sustained gains. However, I'm watching that oil price carefully, because if it continues climbing toward $100, that changes the inflation calculus and could force the Fed's hand.
Let's talk about the technical picture. What are the indices telling you right now?
Looking at the major indices, the S&P 100 is showing solid momentum above its 20-day moving average with support around the 5,800 level. We've got clear upward momentum, but I'm watching for any exhaustion signals given how extended this move has been. The Nasdaq is the strongest of the three, which makes sense given the AI-driven rally. We're seeing new highs with strong volume, and the tech-heavy index is benefiting from that Nvidia news. Key support sits around 17,500, and as long as we hold above that, the trend remains intact. The Dow is actually the laggard here, which is typical when growth and tech are leading. It's consolidating near 43,000, and we need to see the industrials and financials pick up some slack to confirm broad market health. The Dow's relative weakness isn't alarming yet, but it's something to monitor because historically, when the Dow can't keep pace, it can signal a rotation or correction ahead.
What does this environment mean for traders looking at the week ahead?
Traders need to be selective and nimble right now. The geopolitical premium in oil creates both opportunity and risk. Energy stocks are the obvious play if you believe tensions escalate further, but you're buying into momentum that's already moved significantly. I'd be looking at refiners specifically because they benefit from the crack spread widening. On the AI and tech side, the software names that rallied on the Nvidia news still have room if enterprise adoption accelerates. ServiceNow and Adobe aren't cheap, but they're not in bubble territory either. The risk is that we get a volatility spike from the Middle East situation, and some analysts are calling this a potential volatility spasm that could test the 9-week rally we've enjoyed. Position sizing is critical here. Don't chase extended moves and make sure you're not overexposed to any single theme. The market is giving us opportunities, but it's also flashing some caution signals with oil spiking and crypto showing weakness, which we'll get into later. Crypto trends section.
Speaking of crypto, Lizzie, there's been some notable movement in digital assets. What are you seeing in the crypto space heading into this week?
The crypto market is facing significant headwinds right now. Robert and Bitcoin is showing some real vulnerability. We're looking at a bearish to neutral outlook for BTC in the near term. The big story is that spot Bitcoin ETFs just experienced their worst outflow streak of 2026, with 10 consecutive days of redemptions and $1.67 billion bleeding out of crypto funds overall. Bitcoin retreated below $72,000, and analysts are warning of potential downside risk to $65,000 if that support doesn't hold. What really caught my attention was MicroStrategy breaking its 4-year Bitcoin buying streak. They actually sold 32 Bitcoin for $2.5 million in late May, which is a significant sentiment shift from Michael Saylor's usual playbook. Now, he's been teasing a potential new purchase with some cryptic tweets, but that sale was notable. The key levels to watch are 78,000 on the upside as resistance and 65,000 as the downside target. If we break current support, US PMI data could provide a bullish catalyst if it comes in favourable, and some analysts are calling these ETF outflows a contrarian indicator, meaning we might be near a bottom.
What about Ethereum and Solana? How are they positioned?
Ethereum is in a more precarious position technically. Each broke below the critical $2,000 support level, which is a bearish development. The next major support is around $1,800, and without strong catalysts, that's likely where we're headed. There was also a $230 million exploit in the Aave protocol involving ZIF that exposed some bridge risks, which doesn't help sentiment around DeFi security. The positive note is that a developer unlocked $2 million stuck in a 2016 Ethereum ICO contract after 9 years, which shows ecosystem maturation, but that's not enough to offset the technical breakdown. Solana is actually showing relative strength compared to Bitcoin and Ethereum. The sentiment is neutral to cautiously optimistic because there's continued speculation around Solana ETF approvals, and Sol is benefiting from rotation out of the struggling majors. There's less negative news specific to Solana, and it may offer a safer haven within crypto if you're looking for exposure. The institutional versus retail dynamic in Bitcoin right now is interesting because we're seeing institutions pull back with those ETF outflows, while retail sentiment remains surprisingly positive according to sentiment data, showing the most lopsided positive ratio for 2026. That divergence is worth monitoring because historically, when institutional money leads, retail follows, not the other way around.
That wraps up today's Morning Bell. We've covered a lot of ground, from Middle East tensions driving oil markets to the AI-fueled tech rally and the challenges facing crypto. The key takeaway is that we're in a market environment that rewards selectivity and risk management. Keep your position sizes appropriate and stay focused on the technical levels we discussed. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you never miss our daily market insights. I'm Robert, and we'll see you tomorrow morning.